Ladies and gentlemen, good day and welcome to Q4 and FY21 earnings conference call of JB Chemicals and Pharmaceuticals Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jason D'Souza, Head Investor Relations, JB Chemicals and Pharmaceuticals Limited. Thank you, and over to you, sir.
Thank you, Margaret. Welcome to the earnings call of JB Chemicals and Pharmaceuticals. We have with us today Mr. Nikhil Chopra, CEO and whole-time director, Mr. Kunal Khanna, President, Transformation, and Mr. Vijay Bhatt, Chief Financial Officer of JB Chemicals and Pharmaceuticals Limited. Before we begin, I would like to state that some of the statements in today's discussion may be forward-looking in nature and it may involve certain risks and uncertainties. A detailed statement in this regard is available on the Q4 FY21 results presentation that has been sent to you earlier. I would like now to hand over the floor to Mr. Nikhil Chopra to begin the proceedings of the call and give his opening remarks.
Thank you, Jason, and good afternoon, everyone. This is Nikhil Chopra. A warm welcome and thank you for taking time to join us for the discussion on the operating and financial performance of JB Chemical and Pharmaceutical for the fourth quarter and financial year ending 31 March 2021. I hope all of you, your families and colleagues are keeping safe through this difficult phase of time. As the situation continues to ease and the lockdown opens up, we look forward to better times in future. I will start with an overview of our performance and share some of our perspectives on the business, following which Mr. Vijay Bhatt, our CFO, will take you through the key financial highlights. After that, we'll be more than happy to take all your questions. We announced our results yesterday with company recording 15% top line growth in the revenue of 2,000 crore, which was a milestone for us in the history of JBCPL as a company. This performance has been delivered during one of the most challenging periods in recent history on account of pandemic. Further, the strong revenue growth has been achieved with our core brands and non-COVID portfolio. Thus, the growth achieved during this year reflects the resiliency and the sustainability of our business. EBITDA margins expanded from 21.3% to 27.4% in this financial year, and profit after tax was higher by 65%, which was close to 450 crores for the year. Our domestic formulations business performed well during the year, registering a growth of 12% at 892 crore. As per IQVIA May 21 data, we recorded a robust 21% growth as compared to 4.5% growth of Indian pharma market for the same period. I am also happy to share that overall our ranking in IPM has improved from 32nd to 28th rank. We are, by the way, the fastest growing company in top 30 today as recorded by IPM. This was just another year of secular outperformance driven by our strength in chronic therapy segments and acceptance of our products, prescriptions, that is now extending deeper into Tier 2, Tier 3 and beyond. During the year, we have implemented a new go-to-market model for our domestic business and introduced selected new products in complementary therapeutic areas of our strength. We have also instituted a core nephrology task force to capitalize on our strengths in this therapeutic area. Next, our foray into the field of respiratory and pediatric therapy is being taken forward by a strong 350-member team task force, which is the name of the division is NOVA, with focus on antivirals, oral corticosteroids, anti-allergics, and nicotine replacement therapies. The transformation journey is supported by continuous efficiency, driving initiatives like Salesforce automation and excellence, and overall incremental physical adoption. That is what I believe, that how do we complement the presence of our field members in the clinic with the help of digital adoption. Overall, we expect our India business to maintain its outperformance based on the growing visibility with prescribers, specialists, and the pipeline of new launches in line with our therapy diversification plans in complementing therapies. Talking about our international business, we are currently putting in place a growth strategy for key markets which will be aided by new product introductions. As you may know, we remain committed to going deeper into some of the existing markets and geographies without diluting our focus. We are also strengthening our R&D capabilities that should support the medium to long-term growth opportunities in our international markets. During FY21, I am very happy to share that we have seen a good momentum aided by strong performance in South Africa and US business. Also, I would like to talk about the industry growth in Russia, especially in the field of cough and cold segment, has slowed down in the last financial year, and this impacted our business momentum in that country. In other emerging markets, we are well placed with a strong export order book. Also happy to share the entire API business recorded a positive growth for the year, which was both in US and Europe market. Friends, over the years, our initiatives across both domestic and international business segments have yielded positive results with a revenue growth of 13% CAGR over last 4 years. Also, our operating margins have continued to expand throughout this period, and profit after tax has grown at a CAGR of 48% in this 4-year period. ROCE has continuously expanded from 15% in FY18 and it stands at 42% for the year FY21. We strongly believe that our endeavor will be to maintain a healthy ROCE, which indicates our commitment of delivering value to our stakeholders community. Most importantly, we continue to generate a free cash flow during this financial year. Our healthy and strong balance sheet will provide us opportunities to grow our business, especially in India business, consistently, and we'll continue to focus on organic growth, which will be market beating, and also invest in inorganic opportunities, which will add value to the organization in the medium to long term. Going into FY22, we expect the top line trajectory to continue with commensurate benefits of operating leverage. Even as the costs are normalizing, the cost efficiency initiatives instituted over last 1 year are supporting the profit growth, and further improved working capital levels are enabling continued and strong cash flow generation, which is overall helping in maintaining the better EBITDA margins. Overall, our strengthening business position based on multiple corporate initiatives that we have taken over last 1 year places us well to enhance value for all our key stakeholders. On this note, I would like to conclude my opening remarks and now request Mr. Vijay Bhatt, our CFO, to share a brief perspective on our financial performance. Over to you, Vijay.
Thank you, Nikhil. Good afternoon, everyone, and I welcome to JB Chemicals Q4 earning call. I will now take you all through some of the key financial highlights of our performance for the quarter and the year ended 31st March 2021. As you will have noticed, Q4 saw 19% growth in revenue at rupees 528 crore. Margin also expanded by 270 basis points to 23.4%, even as our operating expense normalized to a large extent. However, as Nikhil indicated earlier, we have looked very closely at our cost structure, and some of the interventions made have enabled structural improvement. Our EBITDA expanded by 35% to 124 crore, primarily driven by growth in top line and the operating leverages. Profit after tax also doubled to 101 crore. During the fourth quarter, domestic formulation revenue increased by 9% to 221 crore, based on positive sales traction in line with our expectations and improvement in demand from acute and hospital segment. Growth for the quarter in this segment has also achieved over the higher base of the corresponding quarter last year. Apart from the domestic business, the international business also delivered a healthy growth of 31% in quarter 4. Revenue expanded to 303 crore. Overall, both domestic as well as international business have performed well on a normalized level. For the full year 2021, revenue grew by 15% to a value of 2043 crore. What is more encouraging is margin expanded by more than 600 basis points to a very healthy level of 27.4%, and profit after tax expanded by 71% to 597 crore. This translates into an EPS of 58 for the whole financial year 2021. The board has recommended final dividend of 8 rupees per share. This, of course, is in addition to the interim dividend of 8.5 rupees per share declared earlier in the current financial year. This takes the total dividend payout to 16.5 rupees per share for the full financial year. I would also like to highlight some of our other facets of financial performance. Most importantly, return on capital employed has improved significantly from 29% to 42% during the financial year. This follows a strong track record of continuous expansion in return ratios. We have also growing by leveraging our existing manufacturing, distribution and relationships, and expect to continue a similar direction in the FY22 as well. Our cash balance position also indicates that it has substantial liquidity and it has grown over the last year. Our net cash position as on 31st of March stands at 663 crore. Our current balance sheet position indicates that substantial amount of liquidity available to the company, based on which we look forward to pursue growth opportunities to drive further value in the business. What I have conclude in my remarks, we would like to open this forum for all the interactive sessions with all of you, and we'll be happy to respond to your questions which you people may be having. Thank you.
Over to you, Margaret, for the question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking a question. Also, participants who wish to pose your questions online, please click the link available on the call invite to submit your questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sriram Rathi from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity and congratulations on great set of numbers. Particularly in the India business, this year we've seen that the growth momentum has continued to be strong. If you can share some perspective in terms of the progress which has happened in terms of launching new products in the new segment. So, which segments we have already seen the product launches already have started in FY21, and how should we look at in terms of FY22? From the new segments which we were planning to enter.
So, from perspective of new launches, that the new initiatives that we have taken in India business, that we started doing in quarter four of the last financial year. What I shared in my earlier talk, that playing to our strength and keeping it focused, we are a dominant player in the world of hypertension within cardiology. We have extended that in the world of metabolics by launching couple of products in diabetes. That already products are in the market, which is dapagliflozin and vildagliptin. That is point number 1. Equally, we have taken initiative to launch a niche division in the field of nephrology. Today, at JB Chemical, nephrologist as a specialty is number 1 prescriber specialty for us. So we have launched around half a dozen products in the field of nephrology, which are in phase of launch, which is going on with a task force of around 30 people, and that products are all co-prescriptions in supportive therapy. That is point number 2. And equally, we are in the process of getting into the world of pediatrics and respiratory, which is a combination of anti-allergics, corticosteroids, and some other cough and cold products. So all put together, you will see around 8 to 10 products within next 6 months, which will start getting support from the doctor community in the field of pediatrics, in the field of respiratory, in the field of nephrology and metabolics.
Okay, that's helpful, sir. So, I mean, will existing sales force be able to manage all this, or if we will be looking to add more sales force?
So last time also in our investor presentation, we had shared that there are no plans short to mid-term to add any field force. The entire new go-to-market strategy that we have put and the entire transformation piece that we are putting in place, we have realigned our field force and we are optimizing our entire field force of 2,000 people in India business with the focus that we want to put in terms of making our big franchisee, top big 5 franchisee bigger by focusing in metro and tier 1 town and looking at what we can get maximum from our legacy product in tier 2 and rural part of the country. And also we have realigned our field force where the newer initiatives will be baked in and the same number of people will be more focused in not only delivering organic growth with the help of our existing products, but also give justice to our new launches.
Okay, got it, sir, got it. And so secondly, I mean, export growth has also been quite strong this year. Is it possible to share the details of, I mean, how has South Africa done and how has US and how much revenue they would have reported?
So we don't want to discuss the details of each geography, but international business continues to show a very strong momentum. The 2 key geographies which have done extremely well for us are South Africa and US. Apart from that, we also saw very good, strong growth through the last year in our API business. As things stand right now, our order book momentum continues to see a similar trend, and we are confident of the momentum continuing.
Okay, got it. And so lastly, on the margins, I mean, this year, of course, we have done around 27% plus margins. So any direction you will like to give? I mean, how should we look at this number going forward? I mean, will we be able to sustain this or improve from here on?
So overall, if you look at the expansion which has happened in margin from 21% to 27%, more the way we look at from a margin perspective and going ahead the way we are looking at it, we are looking at margins to flow from top line. We are looking at profitable growth and the cost initiatives that we have taken over last 1 year, and we are looking at enhancing the productivity not only in India business but across the company will help us in terms of maintaining healthy margins which will be close to where we are positioned today. But also I would like to talk about that we are looking at business not only from short term but we are looking at business from mid to long term where there will be some of the initiatives maybe in the field of R&D and some of the investment which we will do to fuel the growth for the coming time.
Okay, got it, sir. That's helpful. Thank you.
Thank you. The next question is from the line of Ashwini Agarwal from Ashmore Investment Management. Please go ahead.
Hi, good afternoon and congratulations on a very nice set of financial performance. 2 questions. Could you provide an update on the lozenges business? I note that that word has come up like a couple of times in your company summary, so obviously you feel quite strongly about it. Where is it now and where can it go to?
Yeah. So, our lozenges business, we have very strong franchise and relationships with some of the large multinational consumer companies globally. And as stated earlier, we are amongst the top 5 and some of the selected geographies, which includes Russia, CIS, parts of APAC and Australia. We are the largest manufacturer for these multinational clients and their respective brands. We are currently at a stage where we are investing on the R&D side to come out with the different varieties of lozenges because our current portfolio comprises of a lot on the cough and cold segment. While we have been very aggressive in terms of introducing and discussing these new concepts with our partners, our attempt right now is to go beyond the conventional cough and cold and introduce concepts like immunity, which are going to be extremely relevant, as we look at the post-COVID scenario. What we can say is our current focus is to strengthen and deepen our presence with our existing clients based on some of these newer concepts, and I'll also add a couple of more anchor clients who could support the lozenges business expanding in a few other geographies where we are not present.
Would it be possible for you to get the same multinational clients to extend coverage into Europe and the US, or is that already done?
There is a slight gestation period because there are some registration timeline which one has to go through. But having said that, there is still a lot of opportunity in geographies where we are currently also present, because we believe that some of the new concepts, particularly centered around immunity, will see a lot of traction going forward in this space. Having said that, these things take time because, you're dealing with the large clients and you have to go through the entire development cycle.
Could you share with us how big is the lozenges business?
See, there are multiple reports which actually state which actually kind of peg the market at close to $5 to $7 billion. Having said that, what we operate is in the complementary medication and wellness segment, and that is close to 30-35% of the overall market opportunity. We don't want to spread ourselves thin across, plain, confectionery lozenges and those plain vanilla segments. We are very clear that we will be operating in a space which is much more niche and which kind of goes through the registration cycle, which is very similar to conventional pharma products.
Okay. And my other thing was on APIs. You mentioned in the opening comments that APIs did quite well for you over the last 1 year. What are the plans here? Because this is again an area where you have a lot of spare capacity apparently.
Yeah, see, we have a very selective play as far as API business is concerned, and strong marquee clients for whom we are a dedicated supplier. What happened with API business, last year was, especially in H1, there was certainly some level of stocking which happened from the buyer's end, given the uncertainty in global markets. Our mid and long-term focus, as far as our API business, will continue to be much more selective and focused. We will certainly be expanding our portfolio base, but again, we are not talking about a spurt of launches of 15 or 20 products. We are looking at some 3 to 4 niche products which we want to play in, and which we are working on, which should be ready for the market over the next 12 to 18 months. So that's the way we are really thinking about our API business. In addition to that, part of our API business will also be aligned to our overall ANDA strategy. So as we have discussed earlier also, we want to kind of increase our filing run rate. We currently have a run rate of 1 to 2 filings per year, which over the next 12 to 18 months should go up to 3 to 4. And some of these ANDA filing which we will look at will certainly be supported at the back end by our API business.
Okay. Thank you and all the best.
Thank you. The next question is from the line of Rahul Jivani from IIFL. Please go ahead.
Yeah. Hi, sir. Thanks for taking my question. Now, as far as the outlook for the India business is concerned, this year we saw very strong growth despite the overall market being weak. Now, as far as the recovery in the domestic market is concerned, April and May have seen very strong growth for some of the acute therapies, and I'm assuming that our Rantac and Metrogyl brands would have also seen some sort of an uptick in prescriptions. So given that background, do you see that for FY22 our India business growth could be higher than 13 to 14% which we have been delivering?
So Rahul, as I stated in my commentary, conceptually the CAGR growth that we have demonstrated over the last now 4 years has been 13-14%, which has been market beating. And obviously we are looking at where we stand from a productivity perspective, where we have got 2,000 people and the entire new go-to-market strategy and the transformation that we are putting in place. We are looking at that how do our productivity in our last investor presentation, what we spoke, should grow at around a healthy pace of 12 to 14%. So that is where we stand with our organic brands, the initiatives that we have taken in terms of how do those brands become bigger, beat the market as they are leaders in their space, and with the newer initiatives that we are taking in with the help of entire adoption of combination of digital and physical presence should overall help us to deliver market-beating performance.
Sure, sir. And on Metrogyl and Rantac, so last year our prescriptions were impacted to some certain extent. So have we seen prescriptions in these two products coming back for us now?
Yeah, if you look at the Rantac performance, we have been handsomely growing at around 15% plus as reported in IPM. And we were fortunate enough that the entire season for Metrogyl also came back, and we saw a good uptake in overall Metrogyl prescription across, because in Metrogyl we have around 10 SKUs. So across all the 10 SKUs, we could see a good uptake in terms of product being adopted at the prescription of the customer.
Sure, sir. And on the CMO business, we have seen very strong growth this year. So historically, our CMO business has been growing at around 11-12% rate. But this year we saw almost 27% growth in the CMO business. So is there any one-off component sitting in there, or what led to such strong growth on the CMO portfolio?
Rahul, it looks like that this number seems to be not correct. In any case, this percentage where from you are getting, we can't comment. And so we can take this offline, but this is not something that can be answered now.
So strategically, without comment, I don't want to get into the number which you have stated, Rahul, because there seems to be some deviation. But having said that, yes, our CMO business has grown very strongly. In fact, Q4 performance for CMO was much stronger than what we saw throughout the year. But this business has to be, kind of analyzed and tracked over a much more longer period. What we maintain and what we have discussed earlier also, our focus is that, how do we expand our CMO client base from, 3 key customers, 3 to 4 to almost 6 to 7, and our efforts are underway to do that. But more importantly, with the current client base which we have, how do we further deepen and strengthen our relationship? And the good thing is that, with the level of R&D which we are doing, we have got, more airtime with our key customers in talking new concepts, and hopefully some of them should materialize over the next 1 year.
Sure, sir. And lastly, on the margins, so you said that some of the cost initiatives which the company has been implementing, that has allowed us to derive structural improvements as far as our cost structures are concerned. But this quarter, we saw that with other expenses coming back, our margins have gone down to 23.5%. So with respect to margins for next year, fiscal 22, so we should be working with the full year number or the fourth quarter run rate which you had, and in terms of any guidance which you can provide as far as margins for FY22 is concerned?
Rahul, what I shared earlier, in terms of when we look at from a margin profile, margin will flow from the top line that we are able to achieve, and we firmly believe in profitable growth. That is what we have laid down as a ethos of running the organization. And equally, if you look at quarter 4 in isolation, conceptually quarter 4, March is a muted month, particularly for India, as overall reported in IPM. So that was one off, but with margins flowing from the top line, which is market beating, and equally some of the cost improvement measures that we have taken in, and looking at how do we enhance productivity across the company, I think we are very much there in terms of we'll be able to maintain our healthy EBITDA margins as we are positioned today.
Sure, sir. Thank you. That's it from my side.
Thank you. The next question is from the line of Monisha from Antique Stock Broking. Please go ahead.
Yeah, hi. Thank you for taking my question. So, question is on the exports business. So, what would be our growth plans and growth drivers for markets like Russia, South Africa, and some of the Southeast Asian markets?
So, as far as Russia is concerned, we are planning to have a couple of launches through financial year 2022. Our registrations are in very, very, very advanced stages. Having said that, given the current market situation, we want to be very mindful of what is the right time to launch these products. if things improve from here on, then we are extremely hopeful that we should be in a position to have these couple of products launched by September of the coming financial year. Overall, the situation was grim, not only for us, for the entire pharma market in Russia, with secondaries being significantly impacted. But we do see improvement gradually kicking in. South Africa has done extremely well, and it's a mix of public and private business. The good thing is we have good visibility on our public business side, and we worked a lot on site variation projects to ensure that we have sourcing done from India, which kind of helps us better manage costs as well. So we will continue to see the good mix and traction in public and private kicking in with the visibility which we have in hand right now. As far as APAC geographies are concerned, now APAC is something where our focus will be to grow these markets through our CMO business, and as mentioned earlier, we are looking at ramping up our R&D with our CMO customers and looking at some variants in dosage forms such as lozenges, but that takes time. The efforts are already underway.
Right. So for the ROW business, do we intend to open up new markets? I mean, are we working on that direction, or we are focusing on the markets where we are?
Our efforts are to continue in the markets where we are present. We are present in almost 42 markets. We want to deepen our presence there. And the other, we discussed South Africa and Russia in detail because these are our home markets. But even in other markets, our efforts will be to deepen our presence through our expanded portfolio. So what we are really looking at is how do we kind of have a portfolio engine over the next 12 to 18 months, which gets us faster registrations, faster approvals, so that we can expand our basket. But right now, there is no real intention of expanding our geography base.
All right. And sir, lastly, on the CMO Los Angeles business, there we intend to expand our capacity given that we are confident of the growth continuing forward. Anything on that?
We already have built-in capacities for lozenges as far as our CMO business is concerned. So there is no real immediate plan to expand on our lozenges manufacturing capacity. We are well covered for that, even if our business has to go up by almost 1.5 times from here on. That's not a challenge. Having said that, CMO business goes much beyond lozenges as well. Many of our current customers are talking about some other dosage forms as well, and those are also concepts underway.
Okay, that's helpful. And sir, lastly, on the Los Angeles business here in India, do we plan to take more products via OTC route, or is something too early to say right now?
Initial stages of conceptualization from our side. We will discuss more details at the right time.
Got it. Thank you so much.
Thank you. The next question is from the line of Nitin Gosar from Invesco. Please go ahead.
Hi team, thanks for the opportunity. Wanted to understand how do we see pediatric and respiratory?
I'm sorry to interrupt you, Mr. Gosar. We cannot hear you very clearly.
Yeah. Is it better, ma'am?
Yes, this is better.
Okay. Wanted to understand, team, how should we see pediatric and respiratory? Until so far, we had some of the other complementary for our existing therapy. Like it could be metabolic or it could be hypertension along with nephrology. But with pediatric and respiratory, it may be slightly more concentrated and more specialized doctors who will be seeking our attention for the first time. Could you help us understand how we intend to build relationship out there and how is our positioning out there?
So let me break this respiratory into two parts. Respiratory is a combination of cough and cold, anti-allergics, and there are a variety of products that doctors prescribe. And when we look at respiratory, which has been because pediatric patients land in the clinic of pediatricians, where JB as a company has very good relationship based on our portfolio, which is a combination of Rantac franchisee, which have got syrup formulations, and there are some other products which already we are going. And equally, when we talk of respiratory, we also talk of physicians and pulmonologists. Am I audible?
Yeah, sir. You're audible.
There was some disturbance. So there are a portfolio mix which we have already taken initiatives to put half a dozen products in the market, which is complementing when we go in the clinic of pediatricians, physicians, and chest physicians. And there is an ongoing relationship building exercise with the help of entire medico marketing excellence, which we have taken some steps in getting close to the customers, and how do we help our team when they go in the offices of doctors. So overall, pediatricians, we as a company are close, and physicians also with the work that we have done in the world of hypertension. So they know JB Chemical as a company, and equally pulmonology as a category. Basically, starting from me, and there are people who are working with me as a team. We know this subject over last decade, over the previous experience that we have. Just to talk to you, Nitin, we are not getting into the world of inhalation, but we conceptually want to build our franchisee around cough and cold, anti-allergics, oral corticosteroids, antibiotics, antivirals. That is where we stand when we talk of respiratory, which is a combination of pediatricians and chest physicians.
Got it, sir. Thank you.
Thank you. The next question is from the line of Aditya Khemka from InCred AMC. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, firstly, on the promotion and traveling expense savings keep talking about. So how much would have been saved in FY21? I saw in your annual report of FY22, the three costs put together was about 155 crores, traveling, conveyance, and commission on sales, and promotion expenses. So if that was about 155 odd in FY20, how much would that be in 21?
Yeah, Aditya, Vijay here. I think
Hi, Vijay, sir.
in promotion and traveling is primarily driven because of the lockdown. So the amount what you are saying is true, is just around 155. In the current financial year, this is at a very subdued level of close to about 100 and in the range of about 135. I don't have the exact number, but the saving is not that to great extent, because after the H1, the normalization was gradually starting, and we also started our field activity. So I would not put that as a big potential saving that we had got and got reflected. In a way, things are now gradually back to the normal level, and the saving that we had in the early part was not that too big in the absolute term.
Understood. Vijay sir, I asked the question because your total other expenses was 417 crores in FY20, and this year we have done almost 400 crores, and this is excluding R&D. So including R&D, maybe last year was 440 crores, and this year we are at 440 crores. So similar numbers, YOY. But there would have been some escalation in your power and fuel costs, transportation costs, because those things have gotten dearer because of the COVID situation. So you must have saved costs somewhere to compensate, to report flat numbers. And if that saving you are saying is only 20 odd crores, then which means the inflation in power and fuel, freight costs, etc., was only 5%. Can that be true?
I think the math seems to have been done by you. This is not 100% true. Secondly, the number which you are reflecting is not excluding R&D. It is R&D is not separately otherwise published. But the fact of the observation of yours is on logic true. Yes, there are certain normal activities like power, because we as a part of essential service, we continued our operations. So with the increase in the overall business volume, the power cost goes up. But there are some advantages because of this lockdown, and that overall helped us not to have the higher expense-based growth. And that's where the overall expense you would have observed is close to around 400 crore. So I don't think that we should more get into the numbers of how much would be saving or how much would come back and all. the management's focus is more on which are those cost efficiency improvement areas where we can try to optimize, and then that drive only our main attention and focus is going forward, which only is going to drive over the EBITDA expansion that we are looking at present.
Understood. Sir, another question on similar lines. We had export incentives of 29 crores in FY20, and this year obviously there were export incentives was there only for 5 months. Can you quantify how much export incentive did we realize this year, FY21?
No, I think this export incentive, there is a lot of confusion. More particularly, the confusion has emerged after 1st of January. But what is the challenge? I mean, for us, the incentive is not reduced to a great extent, subject to only the capping which came in somewhere in the quarter 3 of the financial year. So, from the accounting point of view, we do have to do the benefit which is entitled as per the scheme, which we have done. The only challenge as of now, which practically all exporters are facing, is the new scheme of RoDTEP, where the benefit of percentage is not defined. So that is something is an ambiguity as of now, and it's something which anybody's guess. We can't comment upon what would be that percentage which government will come out with. So subject to that, our export incentive is more or less in line. Of course, little lesser than what it could have been, going by the growth in overall international business. But that is what it is, because there is an ambiguity about the incentive rate as of now.
Got you. So another question on the business. So we said that we were planning to ramp up our export business, and we are investing in filing more ANDAs. That sort of gives me an impression we are underutilized in terms of our current capacity that we have in exports, or we see more opportunity going forward and we need more capacity to cater to that opportunity. So can you talk a little bit about what your current capacity utilization is on the export side in terms of manufacturing capacity? And therefore, do you need further capex? If yes, how much in the next 1 or 2 years?
See, I think the capacity utilization varies across different dosage forms. The average utilization for us currently is pegged around 60 to 65%. Of course, given the the export market situation, it tends to be slightly fluctuating over different periods of time. For us, what's important is for us to expand our export business. What are the new products we are working on, which should have a good commercial opportunity in markets we are already operating, right? We have some initial plans already laid out, and the next 12 to 18 months will be to kind of focus on development of these projects and get them at least to the filing stage. Capacity utilization as of now doesn't seem to be a challenge. And if we have to take a call, we believe we'll be in a better position once some of these products are firmed up, and once we have some more visibility on what the actual, offtake volumes will look like. And that call can always be taken, 1 year down the line. But right now we are well covered.
Right, sir. So any guidance you want to give us on the capex side as to how much capacity, capital expenditure you'll have to incur in FY22-23?
So right now, our capex will go in the same, the maintenance capex which has been historically there. We are close to around 50 CR, and that's what we see. There is no real incremental capex for adding capacities. Having said that, we'll certainly take a stock of the situation maybe 12 months down the line in terms of how much more, incremental capacities we need to add. But right now, it's largely what we are foreseeing is maintenance capex.
Understood. And one last question on the domestic business. On the domestic business, you said you're looking to increase MR productivity and at the same time, you're also entering the new segments of like pediatric and respiratory. Just could you talk a little bit about where the digital strategy or the phygital strategy sort of features here? I mean, because it's the same number of MRs and the product basket is expanding. So how would you reallocate the brands to the MRs? I know you guys have done an internal sort of rejig of the divisions you have had, and you have further made divisions. So how do you incentivize the MR? How do you educate them? What is the gestation period required to get success in some of those new ventures?
The fundamental, model or operating model of the rep detailing and all will not change much, right? We have implemented digital platform to augment the capabilities of our people on the ground, so that they can get better, more airtime with the physicians. And in such times, where getting face-to-face time with the doctors becomes difficult, there are multiple opportunities built in to do remote detailing. But the fundamental operating model of the rep going in, calling on to the doctor, building the relationship and detailing new products does not change, right? And that is going to be the basic premise for us going forward as well. The digital platform also helps us build a better discipline and sales force excellence practices, helps us monitor, the practices of our teams on the ground. Our entire focus has been to, when we have looked at this realignment, is to ensure that there is enough attention which is given to progressive portfolio as well. And we also at the same time have opportunities to leverage our current relationships with the same set of doctors. So as Nikhil was saying, talking about, because we already had relationships with pediatricians, why can't we have 2 to 3 more products on the pediatric side? Because we already had relationships with cardios, diabetos and consulting physicians, why can't we get a couple of more diabetic products as well? Because those relationships already exist. So our strategy remains the same. Bank on the relationships which you have. We don't believe that at this stage we need to add more MRs, but to drive their productivity, we are augmenting them with better digital capabilities. That's pretty much it.
Understood, sir. All the best.
Thank you. I now hand the conference over to Mr. Jason D'Souza to take the questions received online.
Yeah, hi. There is a question we received online from Shine Mukherjee of Nomura. Gross margins are lower in 4Q. Are there any raw material pressures that we are seeing? How are sales promotion costs in India likely to rise in FY22?
So there are some raw material price increase pressures which overall the industry is facing, and conceptually as a business continuity plan, conceptually the commitment and the SLAs that we have laid down and the commitment to our partners across the globe, there were pressures in Q4, but I think over a period of time in next 3 to 6 months that pressure should ease. That is the status as of now. And looking at the overall cost, which for India business operation, I think Vijay stated rightly that costs are going to come back as normal, because I think as of today, in the month of 95% of our people operating today and going in the clinicals. And as we fundamentally believe that we are in a very growth-oriented market, which is growing at a pace of around 8 to 9%. So the entire objective is to look at EBITDA margins from a perspective of how can we have market beating growth. So we will not hesitate in investing in terms of what our people should be equipped to do in the clinic of doctors by helping them, maybe what Kunal was talking with that of all digital initiatives, medical marketing initiatives. But we are very much confident in terms of how we can bring the best out of our people and deliver market beating growth in India.
Over to you, Margaret.
Thank you. The next question is from the line of Naresh Vaswani from Samiksha Capital. Please go ahead.
First question on the...
I'm sorry, Naresh, your audio is very low. Can you please speak a bit louder?
Yeah, am I audible now?
Yes.
This is better, thank you.
Yeah, so question was on the new 7 products which you plan to launch in the nephrology. Can you help us understand what is the market size of these products in India and who are the competitors, and what sort of revenue are you targeting from these new products over the next 2 years?
So we can't get into detail. Is it Naveen?
Naresh.
See, we can't get into detail in terms of what revenues and what is the market size, but conceptually leverage the relationship that we are having with nephrology as a specialty. the products that we have launched are not the products which is first in line, but all the products are more from a supportive therapy prescription that would be in any prescription of a nephrologist, and we see as an opportunity that we can get a better output when we have a niche task force which can go to the specialty and get the prescriptions from the doctors by actually participating with them in disseminating the knowledge. That is what we can share at this moment of time.
Okay. And second, on the cash balance, which is there around 690 crores, net of that also it is around 650 crores. So, what is the plan to utilize that? I mean, currently, are you finding inorganic opportunities at right price where we can align, which can align well with our existing set of portfolio where, the returns are also sustained post the acquisition? Are you seeing that visibility as of now?
We are certainly, very actively and aggressively looking at inorganic opportunities for our India business. As we had mentioned earlier also, we will be very aggressive in looking at value accretive opportunities, something, which aligns very well with our current operating model. And these discussions are always on. But it's always very difficult to pinpoint the time and really mention that when this something like this can get closed. All we can say right now is that inorganic opportunity is a very, very important growth lever, and we are actively looking at such opportunities.
Okay, and lastly, can you help me with the overall capacity utilization, both domestic and exports?
What we mentioned earlier also, we are looking at overall 65% capacity utilization. We would not want to get into details of how much is allocated for domestic and exports. Though I would also want to mention out here is a large percentage of our domestic business is also P2P based, right? And there are always, more flexible options to service your domestic business.
Sure. Thank you, sir. All the best.
Thank you. The next question is from the line of Charulata Redhani from Dalal & Broacha. Please go ahead.
Yeah, hi.
Sorry to interrupt you, ma'am. Your audio is not clear.
Is it better now?
No, ma'am. The volume is very low and it is not clear as well. Can you please check?
Okay. Is it fine now?
It's better. You may go ahead. We will let you know if in case it's unclear.
Yeah. I wanted to know if you could give some idea in terms of the increase because of basic.
I'm so sorry, ma'am. It's still not clear, so I would request you to please check your phone line and rejoin the queue. Thank you. The next question is from the line of Jayesh Shah from OHM Portfolio Equity Research. Please go ahead.
Hi. Big congratulations to the management team for the impressive work done. Nikhil, my first question again qualitatively is, do you think you have managed to get all the low-hanging fruits, or you still think that there is some juice left for the next 2 years, which would set a new normal for the company and then the growth path? And the related question is, would you like to give us some targets over 3 to 5 years, maybe qualitatively, if not quantitatively, in terms of milestone targets that you would look at, and perhaps what the PE investor would be expecting out of the management team?
So, from a low-hanging fruit perspective, it is as per the situation in which we are staying. And am I audible?
Yes, sir, you are audible. Jayesha, please mute yourself while the management is answering the question. Thank you.
Unfortunately, we had a very difficult year, but in that difficult year also, I would like to compliment the team which came across, and there was a full business continuity plan from manufacturing, supply chain, commercial units. So as and when the opportunity comes, whether we are looking at organically, how do we continue to grow and beat the market, look at maintaining our EBITDA margins, which are close to the current financial year, for the coming time. And equally from an inorganic opportunity, as and when we because there are some assets which we are evaluating from an inorganic opportunity, those are the opportunities which we as a company are looking forward to. And you are asking about some color in terms of how are we looking at business in next 3 to 5 years and what is the expectation from PE fund. The fundamental name of the game, Jayesh, is that what I believe in, how do we have the right people in the bus who are going to drive the aspiration for the company, which should be more delivering profitable growth and creating value for our stakeholders and shareholders. That is what we believe in, and that is what we have demonstrated. I think what I was talking about in last 4 years with a CAGR growth of around 13-14% and with ROCE improving from 14 to now 42, which we have achieved. And I am confident with the right team that we have in place at JB, we will continue to look at all the opportunities which are there and continue to deliver market-beating growth, profitable growth, and create value for our stakeholders. That is what I can state at this moment of time.
Right. Just coming back on cash acquisitions and dividends. In the past, JB Chemical used to have much higher payout. If I look at last 3 years. So any stated dividend policy, I can obviously understand if you are waiting to look for opportunity, but any timeline after which you could actually say that the dividend payout would be much larger than what it is, given that your business is not so capital intensive?
Jayesh, Vijay here. We have a dividend policy. Maybe you would not have had a look at it, but I think in history, company did have made payouts which were in some years much larger. But as a company going forward, what we believe in that we would follow some consistent dividend payout policy. Company is generating good amount of cash and we will continue our legacy of rewarding the shareholders. This year we have announced the dividend of 16.5 rupees per share. And I think as a management, we believe that this is a reasonable amount of rewarding to the shareholders going by the profitability that we have. It is in line with our policy. Our policy is about 10 to 30% of profit. Of course, board do take cognizance of the future plans and then the decisions for the payouts are taken accordingly. So as of now, we would maintain the dividend payouts. The quantum of it is as of now reasonable and in future it would be based on the prudence what the board would guide us. This is the plans that company is looking at as of now.
Yeah, my limited point was your business does not require that much of capital. So you could easily have a dividend payout policy of much higher than 30%.
I think this is not what guide or the board considers. I mean, we are now looking into a forward and futuristic growth for the business. And that's where the cash comes to us as a strength. And that's where I think paying out the cash is not a prudency. Management would take cognizance of it, how to effectively utilize the cash sitting on the balance sheet.
Okay, thank you.
Thank you. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, hi, good evening, and thank you for the opportunity. My question is on working capital. Last to last quarter, we saw it spiking, and there is some moderation. But do you expect working capital to be similar levels, or you expect release of cash in fiscal 22?
I think working capital is quite dynamic in the current scenario. Of course, your observation is correct. In the past, it was slightly abated. We are constantly monitoring it. It has come down to our expectation. But I think going forward, it would more be driven by how the market shapes up, particularly the international business that we are into. So this is, I would not say that there would be a very big amount of a working capital release that may happen, because as of 31st of March, we are at a very reasonable level of working capital. There might be little bit of further saving, which we may try to aspire for. But I don't think that now any significant release of working capital is feasible.
Okay, thank you for that. And second one is more of a clarification. Did I hear right that Nikhil's statement on expect to maintain fiscal 21 EBITDA margins of 27%?
What I shared, Prakash, is conceptually the way we are poised, we'll be able to maintain EBITDA margin as of FY21, and it would be probably at the same range. That is what we can share at this moment of time.
Okay. And lastly, the cash which is lying, what is the nature of investments we are into?
So, Prakash, we are evaluating some assets, as last time in my investor call also I shared, and there are some assets which we are evaluating from a perspective of an inorganic opportunity. At the right moment, we'll be more than happy to share the details, because the engine that we operate, particularly in India, if I have to talk about, conceptually, if we are growing at a pace of around 15%, which we have demonstrated the growth philosophy, we'll be more than happy to invest in some inorganic opportunity and complement our business and overall improve the value for our stakeholders by improving overall the top line and margins. That is what we believe in.
But just some clarity in terms of, looking at assets within our core areas where we already have, significant market share like cardio and gastro, or it would be totally new areas where we are planning to expand?
It can be combination of both, Prakash.
Okay, understood. And last one was on the, the cash which is lying in the books. What is the quality of investments that is being done today?
Today we have a policy which is very clearly laid down by our board. We generally deploy this cash into the mutual fund, very highly rated papers, AAA rated generally, of the debt category, and that's the policy that we have been consistently following. The
mutual fund
investments are made are also public in terms of my annual reports, so one can have a look at it also.
Perfect. Thank you and all the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Ayaz Motiwala from Nivalis Partners. Please go ahead.
Yeah, hi, good evening, gentlemen, Nikhil and team. Thank you for taking our call. So I'll go back on the questions asked earlier.
Sorry to interrupt you, Mr. Motiwala. Your audio is not very clear, sir. Can you please come a bit closer to the phone if possible?
Sure. Is this better?
Yeah, better.
Yeah. I'm sorry, the sort of earpiece is right there, very close to where I'm speaking. Thank you for that, and please bear up. So my question was regarding the gross margins and the OpEx improvement, which has resulted in what Mr. Vijay called out the sharp sort of 700-800 basis point improvement in EBITDA margins over the last 3 years. It's quite a dramatic number. Spend some time on some of these initiatives which have led to these margins and the confidence that these will sustain, rather than sort of pinpointing it that if it will be a 21 or a 22 margin. That would be very helpful, sir. That you've had nearly 400 basis point improvement in gross margin. What were the factors which have led to this thing from product to raw materials to any other sort of aspects? And then in OpEx, you had a near 700 basis point saving. Most of it is practically coming in the last year, I would say. So that if you could express, please.
So I think we would answer this in two parts. The EBITDA expansion in the current year is also the factor of the benefit due to the subdued expense because of the lockdown. Operationally, it would not have expanded, honestly, with this level of expense base that we are holding. The other part you are talking about, the gross margin, that is actually speaking is the focus of the company. We have been focusing more on the progressive portfolio and trying to improve on our product mix, which brings more profitability at the bottom. And that is reflected in the numbers for last 3-4 years, with the cardiology segment performing better to our expectation, and some of the international market, particularly some of the regulated markets as well as the chemo business that we are into. So those are all combination of which has helped us to improve the overall gross margin. The EBITDA expansion of the current year, I would say it is slightly not in the normal range. In the ordinary business, the EBITDA doesn't expand in such a big way. But yes, this was an abnormal year. But we are confident that some initiative would definitely help us at least maintain or sustain the range in which we are in as of now.
Right. And so like the way you described about cardio international markets and CMO contributing towards a certain business mix which has better gross margins, if I've understood it correctly. On a similar note, what part of the OPEX is where you think you have talked about these efficiencies of the MR team and any other about 3 or 4 interactions? Could you highlight some of those which are, as you said, as an organization, building on and as takeaways, which means they would basically stay as benefits to the organization?
I think this would be too much of a detailing of it. As in the early remark, Nikhil also mentioned that as a team, we are more looking into the how to optimize our overall operational expense base. Getting into some of these details, in the today's dynamic world, it's very difficult to pinpoint and talk about some numbers, how it will shape up. So I think we would not be able to comment much on it as of now.
Sure. All right, sir. Those were my 2 questions. Thank you very much.
Has put your call on hold. Please stay on.
Thank you. The next question. Thank you. The next question is from the line of Neelam Punjabi from Perpetuity Ventures. Please go ahead.
Yeah, thanks for taking my question. Sir, I just wanted to know if you could just give us a medium-term outlook that over the next 2 to 3 years, what's the overall revenue growth that we can achieve? Can it be mid-teens, high teens? If you can just directionally guide us there.
So, Neelam, I think what I shared in my overall commentary, that what we have demonstrated over the last 4 years with a CAGR growth of around 13%, and that is what team is shown the capability of delivering. And going ahead, I think what we have shared also is from a perspective of how do we make our big brands bigger, how do we deliver market-beating performance, how do we get the best out of the newer initiatives that we are putting in place, how close we can be of maintaining the same margin, same range EBITDA margins going ahead. I think the team at JB Chemical, the leadership team at JB Chemical is more than confident in delivering value for the stakeholders, deliver profitable growth, and look at how, particularly in India, which is 50% of our business, deliver a robust market-beating growth, and look at what is the best opportunity which is available in international markets, which are Russia and South Africa, our home markets, and in the world of CMO, which Kunal was talking. Look at augment the growth, going deeper into the markets where we are present by introducing new products as we are strengthening our R&D capabilities. That is a commentary I can give as of now in terms of what is the horizon for next 2 to 3 years.
Okay, that's helpful. And just lastly, I wanted to know that we have had a good 27.5% EBITDA margin this year. And given that our asset utilization stands at 60-65% blended for the entire business altogether, with growth going ahead, and improvement in scope for improvement in the Russian business, can we see in the medium term these margins go further up and maybe cross a 30% level?
Neelam, I will not be able to give any specific commentary on any number, but what I shared earlier in terms of from a capacity that we have for our manufacturing plant, which is close to around 60% what Kunal spoke, and what initiatives we are taking in terms of cost improvement measures and more EBITDA margins flowing from the top line growth, which is market beating, we will be in the same range of maintaining the EBITDA margin as of what we stand for the year FY21.
And just to add to what Nikhil mentioned, as we continue our focus to drive more efficiencies in our current business line, equally the focus is to invest for future as well. So certainly we are looking at expanding our portfolios for some of the international markets, for the Indian market, and those are things which we need to be cautious of. But the intent and the overall objective is to be close to the same range as we have recently delivered.
Right, got it. Thanks a lot. That's it from my end.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Jason D'Souza for closing comments.
So we don't have any closing remarks, Margaret. So I think with this we can end the call. Thank you everyone for participating, and we will ensure that whoever's questions were not answered, we will make an attempt to answer those questions also. Thank you.
And from my side, thank you all for patience here. This is Nikhil Chopra. I, along with my team, thank you all for participating in our first conference call, and we'll be more than happy to meet you next quarter. And I wish all of you safe health. And with the markets opening up, I think we are looking for a better future. And at the end of the day, the way we think at JB Chemical and Pharmaceutical as a company, how we can work towards bringing more and more smiles on the faces of the patients who tomorrow are prescribed JB Chemicals medicines with the help of the work that our people are doing, maybe in the manufacturing plants, maybe in the markets, with the help of doctors. So that is what we believe in, creating the entire ecosystem where we can contribute in our own way to the well-being of the patients in India and across the globe. Thank you once again all, and we'll meet once again next quarter in our conference call.
Thank you. On behalf of JB Chemicals and Pharmaceuticals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.